For more information, please visit SGMAK Associates website.
Hi, in this module, I'm going to discuss about asset depreciation. As you use equipment, machine to run a business, they depreciate, they lose useful value over time, and it is treated as an expense for the business. It is a non-cash expense. There's no cash outflow. You lose some productive value of a machine with time. They become less reliable, offer poorer quality, so asset depreciates. So this expense is a non-cash expense, and what it does, business is allowed to deduct that expense from the revenue and lower the tax burden. So we'll talk in this module, we'll talk about three different methods of estimating depreciation of an equipment. An equipment depreciates from its initial value to a salvage value, if there's a salvage value, over an useful life. And there are different methods. The basic idea is to depreciate an asset as quickly as you can, so you gain more you get more tax rebate in the earlier years of the equipment life. So based on principles of time value of money, you're making a gain, making a benefit. So we'll discuss three different methods of computing depreciation and compute before tax and after tax rate of return. So let's look at the very first example. The initial cost of a machine is $120,000. Annual operating cost $10,000. Generates an annual benefit of $30,000. Has a useful life of 5 years. Now we can sell the machine for $30,000 when retired from service. So that's the salvage value. First method that we will be using to estimate the yearly depreciation is based on sum of years digit method. So basically what happens, in a year you depreciate the total amount to be depreciated multiplied by a factor by number of years remaining of the machine, number of years of remaining life, divided by the sum of all the digits. So if there's a 5 years useful life, we calculate sum of years digit as 1 plus 2 plus 3 plus 4 plus 5, which is 15. Then year 1 depreciation, you still got all 5 years left. You can think about as you're estimating beginning of a year. So number of years still remaining is 5. So 5 over 15. So about 1/3 of the total amount of depreciation is allocated to year 1. Year 2, following the same logic, 4 over 15 multiplied by 90,000. This 90,000 comes from the initial cost, 120,000, minus the salvage value, which you'll be realizing at the end of his useful life. So that's the total amount to be depreciated. So year 2 is 4 over 15 multiplied by 90,000. Year 3, 3 over 15 multiplied by 90,000. Year 4, 2 over 15 multiplied by 90,000, and year 5, 1 over 15. So total amount depreciated is 90,000. Again, initial cost minus the salvage value. And as you can see, the allocation, the maximum depreciation allocated in year 1, and then you got a descending order. So more depreciation allocation means more tax relief. So in terms of your after-tax revenue, more revenue after tax. So moving on. So you got the cash flow diagram for this problem, and the table shows the summary. So initial cost 120,000. Year one, the revenue before tax, your revenue is 30,000. Your depreciation expense is 30,000 year one. So your net revenue is zero in terms of taxable income is zero. Your tax burden is zero. So your after-tax cash flow is initial revenue minus the amount of taxes you paid. So that happens to be 30,000 in year one. Year two, your 30,000 is the revenue, depreciation is 24,000. So you have a taxable income of 6,000. Revenue minus the depreciation expense. Our expenses are not included here. We have taken a tax burden of 30%, tax rate of 30%. So you are paying $1,800 of tax on $6,000 of taxable income. So really your after-tax cash flow is then, this $1,800 is the real cash outflow in terms of tax. So really your net revenue after tax is 30,000 minus 1,800, which is 28,200. And following the same reasoning, year three, your tax burden is 12,000, tax amount is 3,600, after tax cash flow is 26,400. So that's how it runs. Year five, revenue was 30,000. Your depreciation from the schedule is 6,000. So your taxable income is 24,000. You're paying more taxes this year. Tax is 7,200 is your amount of tax to be paid. So your after tax cash flow or revenue is 22,800. So very last column gives you the after tax cash flow. And then in the very last row, if you see the additional entry of 30,000, that's your money coming from salvage value. So if you take the first column, the second column of the table, that's your before tax cash flow. So you can compute the before tax rate of return, setting up net present value equal to 0. That gives you 13.5%. If you take the after tax, very last column, that's your after tax cash flow, and find the rate of return, that gives you a rate of return of 10%. So before tax rate of return and after tax rate of return after you take care of the amount of taxes to be paid. Now if you want to compute the net present value of this investment at 5% MARR, and if the salvage value happens to be 10,000, the same problem, we are changing some parameters here, then all that it changes is your salvage value at the end plus 10,000. After tax cash flow stays the same, and you are using a discount rate of 5%, and you get a net present value. You got one outflow, all inflow. So use the factor P over A to convert future to present, because you're computing net present value, and that comes out to be $2,840. The method of depreciation, used changes the dollar value of depreciation permitted each year. Now, in case of use of the straight line, if you use the straight line depreciation method, then we have a uniform amount of depreciation each year, which is simply the initial cost minus the salvage value divided by the useful life, which happens to be 18,000. That's every year $18,000. Depreciation looks like this. It's 120,000 initial cost, and then your after-tax cash flow. We have shown you the method, the previous example, 26.4K, and in the fifth year you have an additional cash inflow of $30,000 from your salvage value. Compute the after-tax rate of return, and that comes out to be 10%. Okay. Only note the amount of depreciation changes. Amount of depreciation allocated each year changes with the method used. Okay. So this was using second straight line depreciation method, uniform amount each year. Now let's look at the other method. It's called the double decline balance. So the method is a little bit, it's kind of a hybrid. What happens here, you take the amount to be depreciated, which is the, well, what happens in this case, we do things a little differently here. We have an asset of $120,000. So we will not depreciate it below the salvage value. So year one, we use a depreciation because it's a double declining and 5 years useful life. So you have 2/5. It would have been 1/5 if it was a straight line depreciation, but you do 2/5 on the book value. Initial book value is 120,000. So your depreciation is 48,000 year one. Your book value is 72,000. And your after-tax cash flow, since your depreciation is more than the revenue, you don't have any tax burden. So after-tax cash flow is $30,000. Year two is 2/5 again, but it's on the book value. So your beginning of year two book value is 72,000. So your depreciation is 28,800, which is slightly less than your revenue 30,000. So you have some tax burden. You're paying a small amount of tax, and your after-tax cash flow is $29,640. Your book value is now 43,200. And third year, you take the book value, multiply by 2/5, and that amount comes out to be 17,280. But you are not allowed to drop your book value below the salvage value. So we correct it. Year three, we will not be able to use all the allocation of $17,280. Instead, you will be permitted only $13,200 to keep the total depreciation amount such that the book value doesn't drop below 30,000. Okay. Then year 4 and 5, there's no depreciation allowed because we have consumed all the allocation that you could get. So we have the corresponding, we have the after-tax cash flow for year 3, $24,960, and year 4 and 5 is 30,000 again, and you see an additional 30,000 in year 5, which is a salvage value. And so in this method, we have faster write-off in the initial of the initial expense. We use double the rate permitted by the straight line method applied to the book value of the machine until it reaches the salvage value. And like I said, pay attention to the amount in year 3. You are not allowed to depreciate below the salvage value of the machine. So that's how the cash flow looks like, and initial cost followed by all the inflows. And if you want to find the rate of return, we simply convert the all future value to present value. All benefits have plus sign and cost has a minus sign, negative sign. And when you solve for solvent net present value equals 0 and find the interest rate, and that gives us the after-tax rate of return of 12.4%. So we have discussed 3 different depreciation methods. The goal is to depreciate the asset to the salvage value as early as possible, so we get more revenue, realize more revenue out by paying. It's an expense but non-cash expense, so if we can depreciate more initially, we have a benefit in terms of amount of tax paid, and we have more revenue coming in the initial phases of the useful life. A savings now is preferred to a savings in the future, which is the fundamental principle in economic analysis. As expected, after-tax rate of return depends on the method used to estimate the depreciation. There are other methods available, but these three are commonly used. Your sum of years digit method, straight line depreciation, and double decline balance. Hopefully you'll find it useful. Thank you.
For more information, please visit SGMAK Associates website. For more information, please visit SGMAK Associates website. For more information, please visit SGMAK Associates website.